Finding a debt-free company growing profits at nearly 20% is like finding a needle in a haystack, but Caplin Point Laboratories might just be that rare fortress. Welcome to our Q3 fiscal year 2026 analysis. Caplin is a rare mix of high growth, high margins, and deep safety buffers. Revenue is up nearly 10%, but profit is growing twice as fast at over 18%. With zero debt and over 2,400 crore in liquid assets, the safety here is incredible. Let's look at operating leverage in action. Revenue hit 576 crore, but the real story is the profit after tax surging 18.4% to 165 crore. This means they have strong pricing power and massive cost efficiencies. Margins aren't just holding, they are expanding. EBITDA margins jumped 180 basis points to 38.7%. This is driven by operational efficiencies and a better product mix in the US and Latin American private markets. The company runs on two engines. Engine 1 is the cash cow in Latin America, providing a 37% margin to fund expansion. Engine 2 is the sprinter, the US market, which is growing at over 25% and represents the future. They're successfully cracking the US fortress. US revenue is up 25% this year, with 55 ANDAs approved to date. Their front-end sales team achieved nearly $9 million in just 15 months, proving they are now a serious US contender. In Latin America, Caplin has unrivaled dominance. Their unique end-to-end model from manufacturing to distribution creates high entry barriers. They have a $25 million pipeline in Central America and are targeting top 5 status in Chile within 2 years. This is the fortress balance sheet. Total debt is exactly zero. They have a net worth of 2,850 crore and liquid assets totaling over 2,400 crore. It is one of the cleanest balance sheets in the sector. The earnings quality is top tier. They converted 77% of their profit into actual operating cash flow. Even after 180 crore in capex, they still generated 188 crore in free cash flow, all internally funded with no dilution. They aren't sitting on that cash. They're investing over 1,000 crore for future dominance. This includes massive capex for backward integration and complex injectables. They even keep a year's worth of inventory near customers to ensure fast supply. Caplin is escaping the commodity trap. They are moving from standard generics into pre-filled syringes, oncology, and even GLP-1 weight loss products. They use asset-light models for high volume, but keep high-margin items in-house. At a price of 1,825 rupees, the market cap is nearly 14,000 crore. A PE ratio of 22 is very reasonable for a company growing profits at 20% with a zero-debt fortress of a balance sheet. The risks include currency volatility in Latin America and US FDA regulatory dependence. However, the rewards are high. A massive cash pile to limit downside, and deep backward integration to protect long-term margins. The final verdict is constructive. Caplin Point is a rare compounder. As US revenue scales and complex products launch, the business quality only improves. Plus, they have 2,400 crore in liquid assets ready to deploy. Did you find this deep dive into smart investing helpful? Make sure to like, save, and subscribe ZinvestZ for more smart investing insights. Thank you.